This is not financial advice, educational content only. Headlines about a company in trouble almost always arrive after the filing that said so. The thing actually moving capital is one layer down in a paragraph most people scroll straight past the going concern opinion. Let's look at what the filings say. A going concern paragraph is a statement in the auditor's report that there is substantial doubt about the company's ability to keep operating for the next 12 months. It is one of the very few places in a 10-K where a third party, with legal liability attached, is required to tell you something uncomfortable. And it gets misread in both directions, treated as a bankruptcy prediction when it is not one, and ignored completely when it should change how you read everything else in the document. Be precise about the machinery because the wording is doing legal work. ASC 205-40, introduced by an update in 2014, management is required to evaluate whether conditions raise substantial doubt about the entity's ability to continue as a going concern within 1 year after the financial statements are issued. Management goes first. The auditor then performs its own evaluation under the relevant auditing standard and decides whether to include an explanatory paragraph. Two things follow from that sequence. First, substantial doubt is a defined threshold rather than a mood. It is raised by conditions like recurring operating losses, negative working capital, covenant defaults, or a maturing obligation with no committed means of refinancing. Second, management's mitigation plans matter. If a plan is judged probable of being effectively implemented, it can alleviate the doubt. That is precisely how a company can post alarming numbers and still carry no going concern paragraph. Here is the most common misreading. A going concern opinion is not a forecast of bankruptcy, and the empirical record on this is not close. Research on first-time going concern opinions consistently finds that a large share of the companies receiving one do not file for bankruptcy in the following year. They refinance, raise equity, sell assets, or simply keep trading. The auditor is not predicting failure. The auditor is stating that, on the evidence available at the reporting date, the doubt had not been resolved. Those are very different claims. Conflating them is how people end up either panic selling a recapitalization candidate or dismissing the disclosure entirely because some company got one last year and is still here. Both reactions come from reading a conditional statement as though it were a prediction. That's my read. The useful framing is that this is a classification problem with two error types, and both are well documented in the auditing literature. The first is the false positive, a going concern paragraph followed by survival. Those are common and they carry a genuine cost because the disclosure itself can tighten credit terms and unsettle customers. A self-fulfilling element researchers have examined directly. The second error is the one that should interest you more, the false negative, meaning companies that fail without ever having received a going concern opinion. That failure mode is real and documented, and it is the reason this paragraph works far better as a confirming signal than as a screen. If you are relying on the absence of a going concern opinion to tell you a company is fine, you are using it backwards. So here is the tool concretely. When you see a going concern paragraph, do not stop at the paragraph. Go to the liquidity discussion in management's discussion and analysis and find the specific mitigation plan the company is leaning on. Then check whether that plan is committed or merely intended. A signed credit facility is not the same thing as an intention to seek financing. Then read the debt footnote for what matures inside the next 12 months, because that is usually the condition that triggered the whole disclosure. This isn't advice, it's a way of looking. If the framing helped you read the next earnings call differently, that's the win. I'm dying back next briefing.